All right, then let's dig into the details of this report. Philip Myburgh is the Executive Head of Trade and Sino-Africa Business Section at Standard Bank. He joins us live from Accra in Ghana. Philip, thank you very much for making time for this conversation. I guess let's start with a big picture here. What's the objective in setting up this trade barometer? What policy data gap are you looking to fill?
Good evening. Thank you. Good to be with you. So we at Standard Bank see trade as a core part of driving Africa's growth across the continent. And as part of this piece of work and strategy, we realized that there's just not sufficient information at a ground level around trade and tradability from what business are saying on the ground. There's obviously macro details that's available, but really a lack of good insight. So we did this piece of work first and foremost, of course, to develop our strategy around that. But we realized that we owe it to the community. We need to share this with policymakers. We need to share this with the academic environment so that we could together put our heads around what the businesses are telling us on the ground to really shape trade in Africa and really improve the environment in which we operate.
Let's get back to that, one of those key findings in the report, because when I read this, I found it rather hard to get my head around, because you're pointing out that a lot of your respondents are saying they're not aware of the Continental Free Trade Area. So is it that they know of it, but they haven't seen, for example, a CFTA tariff book or a CFTA set of trading rules compared to the ones that they're using in their respective regions, be that ECOWAS, the EAC, or SADC?
Yeah, it is an interesting one. I mean, I think the 2,500 odd businesses that we interviewed across the 10 markets, I think in certain instances, they're not necessarily aware that the changes that they're experiencing are necessarily linked to the umbrella of the AfCFTA. If you take PAPS, the payment system capability that's currently being piloted in West Africa, folks making use of that payments capability might not even know it's under the umbrella of AfCFTA, and yet it's made a change to their world. So I think not necessarily linked. They might not know of the AfCFTA and its details, but might have experienced some of the impact that it has, and vice versa. It is something that we'd like to unpack a bit more when we run the survey again in 6 months' time.
To what extent is access to foreign currency, particularly the American dollar, to what extent is that a huge barrier to cross-border trade within the continent, especially among countries that are not members of the same trade bloc? For example, trade between South Africa and Nigeria, or trade between Kenya and Nigeria?
Yeah, it's a massive challenge. We're finding it came through strongly in the survey, as you mentioned, and we're finding it within our operations across East, West, and Southern Africa, that lack of FX, specifically in the US dollar, is limiting trade. I mean, in certain days, maybe we can meet in some countries 10% of the demand to fund a transaction, which is really hampering growth. And of course, that stems from our inability to create sufficient export revenue, get paid in dollars so that we can make those payments in dollars. Often the settlement, of course, between countries, in most instances, even within Africa, requires the US dollars. So massive dependency on US liquidity to facilitate trade, which of course is a risk to growing trade in Africa. And that's why the AfCFTA and some of the initiatives around that is so important to address that. But at the same time, diversification and growing our export capability on the continent also very critical to mitigate that risk.
Yeah, and as a follow-up to that, with respect to the Pan-African payment system, the one that is now being funded in part by the Afrexim Bank, that essentially aims to solve that problem. The number we often hear is that having to convert currency, so Naira, dollar, then Rand, going through that entire three-step process costs us collectively roughly $5 billion a year or something of that sort. But to what extent can PAPS really solve that payment problem, that FX problem?
Well, so far in the pilot, it seems encouraging because, of course, the capability allows you to settle directly between the two local currencies and excludes the need for the US dollar. So therefore, I mean, we really hope that it will gain further traction, that the pilot will be successful, and then we can expand that to the rest of the continent, because certainly our reliance on the US dollar, as I said, is holding us back from a trade capability.
In terms of government support, Angola, Namibia, these are among the countries that survey respondents said, look, we're getting a lot of support from these authorities. What are those countries getting right, and can that be replicated across the other countries that were surveyed?
Yeah, that's an interesting one. I think we have to see it relative to the rest of the environment. I mean, we interrogated this a bit in these respective markets, is that on a day-to-day basis, there's so many challenges that these businesses are facing to trade better, that, you know, certain things are a challenge, but not necessarily an obstacle, and vice versa. But certainly when it comes to government, fairly positive reviews around how the respective governments are supporting them. But in the global context, it still needs a lot of work. But specifically to those countries that you mentioned, I think those countries have done quite well in making it clear, communicating quite well around tariffs, around duties, etc. So certainly that's a best practice that can be expanded on. But I don't want to overplay the fact that, you know, there's really a lot of work that needs to be done in this space.
All right, one last question for you. Other than Uganda and Kenya, high transportation costs, there weren't as huge a concern as I thought there might be, considering the fact that for the last decade, actually more than that, businesses have consistently said, look, the cost of just getting things from point A to point B across Africa is a huge hindrance to trade. So is that because there's been progress made in closing infrastructure gap, especially in Western and Southern Africa? Or is that more a reflection of the fact that we have such limited trade amongst ourselves as African countries?
No doubt that there has been pockets of progress in infrastructure. If you look at some of the port capacity being created, road infrastructure, some rail infrastructure being created, but certainly not quickly enough and not sufficient enough to stimulate the growth and trade on the continent. Just to narrow down more specifically, yes, sure, Uganda and Kenya made that reference and said it's a high obstacle. But if you really dive into the detail, you'd see that it still reflects as a medium risk to the rest of the market. So I think your observation and your perception is still the right one, that transport costs is a big challenge across the continent. Relative to some other ones, it might slip down the rankings in some of the markets, but it's still a consistent challenge across our markets, and not just to intra-Africa trade, so too with trade with the rest of the world.
Indeed. We'll leave it there for the time being. Looking forward to seeing what the results of the survey look like, particularly with respect to the CFTA